The US Federal Reserve just announced its first rate cut of 0.5% at the September FOMC meeting. So what is our next move? What should we be investing in right now? Is it still a good time to buy stocks? In today's video, I'm going to break down the 3 winning asset classes that historically perform well when interest rates drop. Hello everyone, welcome back to STA Club, the club for stocks trading and analysis. This channel is dedicated to provide you with a high quality tutorial, guides and insights that demystify the world of trading. But before we dive in, a quick disclaimer. The information in this video is for education purpose only, not a buy or sell call. So what does a rate cut really mean? And why should we care? The US Federal Reserve cutting interest rate by 0.5% might sound like a small little change, but it has huge impacts on the economics and the stocks market. Cheaper borrowing means business can expand, consumer can spend more, and the housing market often heat up. But what's just as important as this rate cut is what comes next. Understanding the outlook for future rate cut is crucial, especially for investors like us. Rate cut often indicate the Fed response to economic challenges such as slowing growth or rising unemployment rates. Understanding the Fed outlook can provide insights into the overall health of the economy, helping us to find industries that well perform. One of the best tools that we have for understanding the Fed expectations for future interest rate is the dot plot. From the dot plot, we can see that FOMC members set a target average range of 4.25% to 4.5% for the federal fund rate by the end of this year, indicating either 2 quarter point cuts or 1 half point cut. Looking ahead, the Fed projections suggest that they expect to implement an additional 4 rate cuts in 2025, bringing the rate down to a range of 3.25 to 3.5%. This represents a significant shift, especially considering that just 3 months ago, officials was less optimistic about future rate cuts, with some expecting none at all. Currently, the dot plot reflects a divergence in opinions among policymakers, while 9 members see 2 quarter point cut in 2024, and 6 members believe that the benchmark rate will fall to 3.2%, and 6 members believe the benchmark rate will fall to 3.25% to 3.5% by 2025. This evolving outlook not only helps us gauge the Fed monetary policy directions, but also reveal potential opportunities in industries that typically thrive during periods of low interest rates, such as real estate and bonds. As we anticipate these changes, it is essential to position ourselves strategically to take advantage of the favorable conditions created by this rate cut. Alright, now we have a clear picture of the Fed outlook and what it means for the economics. It's time to talk about what should we invest in to take full advantage of this rate cut. So let's dive right in. The first asset class you will want to keep on your radar during time of falling interest rate is REITs. Lower interest rate allow REITs to finance new properties acquisitions or refinance existing debt at lower rates, making REITs one of the top performance investments. Let me show you exactly why REITs shine when interest rates drop. So why are REITs such a strong investment right now? Let's break it down. Over the past couple of years, rising interest rate and inflation created a headwind for REITs. Property value corrected and investors pulled back as higher financing costs make it more expensive to invest. Here's the opportunity. As the Fed moves into a period of rate cuts, this environment becomes perfect for REITs to come back. Lower interest rate means cheaper financing for real estate, and that's when REITs thrive. While cash flow at property remains stable, the drop in borrowing costs boosts property value, making REITs more attractive, especially now that they are still trading at a cheaper value compared to the broader stock markets. We already see signal of REITs rally. As 10-year treasury yield begin to decline, REIT shows a strong performance. If we look at the Vanguard Real Estate ETF, we can see that the ETF has gone up more than 50% since July. Looking ahead, as the Fed continue cutting rates, REITs tend to benefit in 2 big ways. First, lower refinancing costs will drive earnings higher. And second, cheaper access to capital will allow REITs to go on the offensive, acquiring property from private owners who may be under financial pressure. This positions REITs to grow significantly in the coming years. And the best part, as rate cuts signal a bottoming out of real estate value, REITs are well positioned to take advantage of buying opportunities. And we could see a major upswing as this uptrend unfolds. Now that we have covered how REITs can capitalize on low interest rate, let's turn to another timeless asset that shines when rates are falling. Historically, gold has been a go-to investment during periods of economic uncertainty and declining interest rates. When the cost of borrowing drops and inflation fears rise, investors often choose gold as a safe haven to preserve wealth. So why does gold perform so well when interest rates fall? It's all being a store of value and a hedge against currency devaluations. As interest rates decline, the returns on traditional safe investment like cash and bonds shrink, which push investors to look for alternatives that can protect their wealth. Historically, gold has been a safe haven during such time. And here's where it gets even more interesting. When the Fed cut their rates, it often leads to a weaker US dollars. As the USD weakens, gold, which is priced in dollars, becomes cheaper for international buyers, boosting demand and driving up price. This relationship between a weaker dollars and rising gold price make gold a standout investment during a period of rate cuts. Additionally, gold is an effective hedge against inflation. As the Fed lower rates to stimulate economic growth, inflation concerns can rise. When inflation erodes the purchase power of currency, investors flock to gold to preserve their wealth. Historically, we have seen gold price surge when real interest rates turn negative or remain low, making gold more attractive. The last time we saw significant rate cuts, gold's price go up as investors look for stability. And with the Fed expected to continue reducing rate into 2024 and 2025, we could see gold price rise further. In time of economic uncertainty or market volatilities, gold shines as a reliable asset for preserved value. Now that we have covered real estate and gold, let's move on to the third asset class that really benefits from a declining interest rate environment, which is bond. Bonds are often seen as one of the most straightforward ways to capitalize on rate cuts. And with interest rates set to fall, they are about to shine. So why do bonds perform so well when interest rates drop? The key lies in the inverse relation between bond price and interest rates. When the rate cuts, newly issued bonds offer lower yield, making existing bonds with higher interest rate more valuable. As demand for this higher yield bond increases, so does their price, allowing investors to benefit from capital appreciations on top of their regular interest rate income. However, buying individual bonds can be less liquid and sometimes harder to trade, especially if you need to sell quickly. Additionally, investors with small capital might find it challenging to buy bonds, as purchasing individual bonds often requires significant upfront investment. That's where bond ETFs come in as a more convenient alternative. Bond ETFs like TLT or TMF are traded on the stocks market, making them far more liquid than individual bonds. You can easily buy and sell them during market hours, just like the stocks. Not only do they require less capital, but they also offer easy access to the bond market, making them an ideal option for most investors looking to profit from declining interest rates. Let's talk briefly about these two ETF I mentioned. TLT gives you exposure to the long-term US Treasury bond, which tend to see significant price appreciations when rates drop. It is a great option for those seeking stabilities with moderate risk. For those looking for even more upside, TMF is a leveraged ETF that aims to deliver 3 times the returns of long-term treasury bond. However, this also comes with increased risk due to the leverage involved, so it is important to approach it carefully if you are looking to boost your returns in the bond market really. When the Fed cut interest rate, it creates a unique opportunity for investors to position themselves for potential gains. REITs, gold and bonds are 3 asset classes that historically perform well in this environment. This investment can help you navigate and profit from rate cuts. Here will be end of our video. Like and comment below to let us know that what asset class you would like to know more. See you in our next video. Bye bye.